Jamie Dimon and the biggest banks in America are panicking. They just sent an urgent letter to Congress demanding changes to crypto law, warning that stablecoins could increase lending costs and reduce loans to businesses. But here's the kicker: they might already be too late. The GENIUS Act just passed with what banks are calling dangerous loopholes, and the crypto industry isn't backing down. This is the final battle for the future of money in America. The Banking Policy Institute, led by J.P. Morgan CEO Jamie Dimon, just declared war on interest-bearing stablecoins. Their argument is simple, but terrifying for crypto. Stablecoins that pay interest will destroy the traditional banking system. Here's their logic. When you deposit money in a bank, they use those deposits to create loans. It's called fractional reserve banking, and it's how banks have controlled money creation for over a century. Your deposits become their lending power. But stablecoins change everything. Why keep money in a bank earning 0.5% when stablecoins can offer 5% or more? If deposits flee to stablecoins, banks lose their funding source for loans. The Banking Policy Institute warns this shift would mean higher interest rates, fewer loans, and increased costs for Main Street businesses and households. In other words, they're claiming stablecoins will crash the economy. It sounds dramatic, but there's a kernel of truth here. Banks do rely on deposits to fund lending. What they're not saying is that this system has given them monopolistic control over who gets credit and at what price. So what exactly are banks fighting? The GENIUS Act, the new law regulating stablecoins in America. On paper, it seems to ban stablecoin issuers from paying interest. Section 4. A11 clearly states that issuers cannot pay any form of interest or yield solely in connection with the holding, use, or retention of stablecoins. But here's where it gets interesting. That word solely creates what lawyers call a massive loophole. Aaron Brogan from Brogan Law explains, the prohibition on interest is probably actually relatively porous. While stablecoin issuers can't directly pay interest, exchanges and other third parties absolutely can. As long as there's any other basis for the payment beyond just holding the stablecoin, it's likely legal. Think about it this way. Coinbase could partner with stablecoin issuers to offer interest to users. The payment isn't solely for holding the stablecoin, it's for using Coinbase's platform, maintaining a relationship, or participating in their ecosystem. This loophole is so significant that many believe the GENIUS Act actually enables the exact stablecoin interest system that banks fear most. Here's the brutal reality for traditional banking. They're fighting yesterday's war. Legal experts say banks are tilting at windmills. The crypto industry already made major concessions to get the GENIUS Act passed. They're not about to accept amendments that gut the entire bill. Jake Chervinsky, a prominent crypto lawyer, put it bluntly, I don't expect more stablecoin legislation in this Congress. Translation, what we have now is what we're getting. But there's a deeper issue. The banking lobby's argument reveals their fundamental misunderstanding of what's happening. They think this is about regulation and compliance. It's actually about obsolescence. Aaron Brogan draws a perfect analogy. Just like digital music files were better than CDs, disintermediated finance is better and easier than traditional banking. People never wanted to use banks for payments, they just had to. Now they don't. This fight isn't really about interest rates or compliance. It's about who controls the future of money. Banks built their power on being the middleman in every financial transaction. Stablecoins threaten to cut them out entirely. When you can hold, transfer, and earn yield on digital dollars without ever touching a bank, what exactly do you need banks for? The Banking Policy Institute warns about unregulated shadow banks and liquidity crises. But crypto advocates argue the real risk is maintaining a system where a handful of banks control who gets access to credit and capital. Consider the implications. Right now, if JP Morgan doesn't like your business model, they can cut off your banking services. With stablecoins, that becomes impossible. You hold your own money, transfer it directly, and earn yield without permission from any bank. The writing is on the wall. Despite the banking lobby's best efforts, interest-bearing stablecoins are coming to America. The GENIUS Act creates the legal framework, and the loopholes are too big to close. This represents the biggest shift in American finance since the creation of the Federal Reserve. For the first time in over a century, ordinary people will have access to high-yield, dollar-denominated assets without going through traditional banks. But banks won't go quietly. Expect them to use every regulatory tool available to slow this transition. They'll push for stricter compliance requirements, higher capital standards, and more oversight of stablecoin issuers. The question isn't whether this transformation will happen, it's how quickly. And based on the banking lobby's desperation, it's happening faster than anyone expected. If you're not prepared for a world where stablecoins compete directly with bank deposits, you're about to be surprised, because ready or not, the future of money is already here.